Welcome to Daybreak Europe. Let's talk about what was going to be setting the agenda this morning. There's plenty going on, starting off with the EU trade story, and that's going to be crucial here as we talk about Donald Trump making a complete U-turn on his 50% tariffs. That deadline now to July 9th. That's going to be crucial. Let's talk about the next major story we've got coming up this morning, and that, of course, is going to be the market reaction to all of it. European equity futures rallying off that delay. However, UK, U.S. cash markets, they are closed for the public holiday. And, of course, going right back to Donald Trump, saying he's considering sanctions on Russia, calling Putin, quote, absolutely crazy, one day after Moscow launched another deadly night of strikes across Ukraine. Welcome back to Daybreak Europe. I'm Kriti Gupta. Let's get a quick check on these markets here because a relief rally across the board. We're looking at Eurostock 50 futures that are higher by about 1.7%. That is a massive boost of confidence when you look at the futures picture. Take a look at what's going on the other side of the Atlantic. Remember, cash markets are closed right here in the UK and in the United States, but futures are soaring, and a lot of that is going to be that relief from the 50% tariffs that Donald Trump talked about inserting onto the EU on Friday. Nevertheless, euro-dollar still higher, 114. We're going to dive into those kind of market dynamics in just a moment. Brent crude also in the background. We've got plenty of news coming out of the Middle East, those growth concerns as well, putting Brent crude at a $65 handle. Now, this is going to be crucial as we talk about how the Asian trade all factors into this. So let's get a check there because you are seeing a tale of two stories when it comes to the Asia story. And that's going to be crucial when it comes to the likes of the Hang Seng down about 1%. That one's interesting given we are talking about the tariff flows and the news coming off not just the EU, but on Apple as well. What companies and their supply chains extending into China could be next. The Nikkei, however, higher by 0.8%. And we have, by the way, seen a bad strength in the Japanese yen as well. Dollar yen at 142.60. Right now unchanged, but keep an eye on that dollar weakness. The ripple effects are going to be crucial going into the end. And of course, quick check on copper. When you talk about risk sentiment being higher, you are seeing a 1% gain in that commodity. Now let's go back to our top story here. President Trump saying he will pause his 50% tariffs on the European Union until July 9th after speaking with Commission President Ursula von der Leyen. The move allowing for more time to negotiate a trade deal between Washington and Brussels.
We had a very nice call, and I agreed to move it. I believe June 9th would be, July 9th would be the date. That was the date she requested. Could we move it from June 1st to July 9th? And I agreed to do that, and that she said we will rapidly get together and see if we can work something out.
I'm joined now by Bloomberg's Oliver Cook, of course, monitoring all of these developments. Ollie, it's been 48 hours and a complete U-turn in the policy. What do we know?
Yes, I mean, Kriti, if you turned off your phone at about lunchtime, Europe time on Friday and then turned it back on today, not a whole lot would have changed, right? Because by sort of Friday, when we had the announcement of 50% tariffs that would kick in next Sunday, June the 1st, by the time we got to Monday, that was delayed to July the 9th. That is the 90-day period, that pause that's already there on all the other sort of tariffs. So going into the weekend, there were discussions going in at the end of the week to try to get sort of closer to the EU-U.S. trade deal. There was a call between Maros Sefcovic and Jameson Greer, the U.S. trade representative, on Friday. And we know at this point that they're not really close enough to where they need to be. And this is what has been prompting the Trump administration to once again threaten those 50% tariffs on the European Union. Scott Bessent, for his part, the U.S. Treasury Secretary, was saying that he'd hope that this would light a fire under the EU in order to get serious about the sort of discussions with the United States. And of course, then Ursula von der Leyen had that call with President Trump over the weekend, basically asking to put all of this sort of on delay until the beginning of July. We should bear in mind that there are still these 10% tariffs in place. We have not got to that point. What has actually changed when we go into these negotiations? What it looks like is that now at the end of that period of time, that end of that 90-day reprieve, what the EU is facing is no longer the 20% tariff that they saw on that board that was listed on Liberation Day, but now 50%. And this is, by the way, a rate that would be higher than what is currently with China. And this is, of course, the great difficulty for the EU when appraising basically the Trump administration's tone against what it considers to be one of its closest allies.
But what are the sticking points here? I mean, Brad Setzer over at the CFR had some really interesting charts over the weekend talking about that trade deficit and what's actually in it. He was saying that the bulk of it comes down to pharmaceutical tariffs. That's a sector we haven't heard of yet when it comes to what the Trump administration, I'm going to try to say this right, is planning for that sector. How much of that factors into where this deal could actually end up?
So, Kriti, I think a lot of what's going on between the Europeans and the U.S. administration is there's really a lot being lost in translation. It's as if they're not really even speaking the same language when it comes to these negotiations. I mean, the way that the court of Trump, so to speak, is sort of playing this is they want everybody to sort of go and present them a plan. The Europeans, on the other hand, are very sort of frustrated because they're saying, we basically don't know what you want from us. And so they get into this back and forth. The Europeans are sort of guessing. So the Europeans have brought sort of different proposals that include a number of different things. They talk about enhancing economic security, mutual investments, strategic purposes. They've talked about partnerships potentially on shipbuilding. They talk about it with potentially on energy, gas, nuclear, and oil. But again, their ultimate aim is to get zero for zero tariffs. It is fairly clear at this point that the Trump administration has basically zero interest in that. I suspect that really if the Europeans want to make progress, it's to go to the Trump administration with something that's, a big, beautiful deal, something that says, hey, listen, over the next 10 years, we're going to spend $1 trillion on LNG and defense contracts, which, by the way, are all things that the Europeans need. The problem is that the sort of EU Commission does not necessarily have the authority to negotiate that. So what Ursula von der Leyen would need to do is get sort of buy-in from the member states to start to talk about potentially collective procurement of things like LNG and weapons, and maybe sort of try to count those up and add those up to present those to the Trump administration saying, hey, listen, this is how we intend to close the trade gap between the United States and the EU.
All right, Ollie, play doomsday with me here. What happens if the talks fail? How bad could this get?
So listen, this is $1 trillion trading relationship. This is absolutely mammoth, both for the European side and the U.S. side. So that is, of course, the worst case scenario. We should say, Kriti, that as we know, even with China, we've not really gotten to the point where we got those very, very elevated tariffs. Either somebody stepped back, there was some kind of negotiation. So we've always drawn back from this. I think as far as the Europeans are concerned at this point, they're all seeing this through the prism of the sort of art of the deal. This is all about negotiations, and that eventually that there will be a sort of deal. But again, they have sort of assembled a retaliatory list. There's $100 billion worth of goods that the EU targets in case these tariffs go into place. They're probably going to have to augment that number ever since this last threat of about 50%. But the real difficulty, and you see it on the screen right there, is that there is a very large trade deficit between the EU and the United States, about $200 billion. And that is what the Trump administration wants to close. And so as a consequence, the U.S. can do a lot more damage to Europe than the Europeans can do to the U.S., to say nothing, Kriti, of the fact that the Europeans still quite need the Trump administration and the U.S. around to support Ukraine. The Europeans here in NATO are still basically kind of auditioning for continued participation of the United States within NATO. These are all the things that, the Europeans are still dependent on the U.S. for. We should say, Kriti, that basically the best ally to the Europeans so far in terms of trade, and maybe the rest of the world, has been the bond market, and we'll see if that remains to be the case.
Absolutely. Does Donald Trump ultimately react to that major indicator, that panic signal, if we'll see, or perhaps Ursula von der Leyen does? Bloomberg's Oliver Crook in Berlin walking us through those dynamics. We thank you so much. But as he talked about the kind of really intrinsic, complicated relationship there, the markets are taking this as a positive. Let's go to that story next. Joined now by Bloomberg MLive strategist Mark Cranfield talking to us this morning. Mark, I'm looking at a 50% tariff deadline extended to July 9th, and yet the euro is higher by is trading at 114. How does that math make sense?
Well, it's good that you have the euro on the screen there, because if you think of what's happened since Friday, since the shock of Trump first announcing that there would be 50% tariffs on Europe, we had equities collapse. There was a haven bid for bonds, and the euro rose to some extent. Come to Monday, there's a reversal of that. Equities are getting a bid, as you described earlier. European stock futures are doing pretty well. Bond yields are starting to go back up. We've seen bond futures in Asia already trade lower today, and yet the euro is going higher again. It's a clear reminder to everybody that all this back and forth uncertainty about whether there are tariffs, when they're going to come in, who they're going to hit, it is a dollar negative. Macro traders have decided for themselves, they decided some time ago, but it's now just a question of reinforcing that narrative that all of this is negative for the US dollar. Money is moving away from that to other places. The euro is, of course, one of the main beneficiaries. It is the second largest currency on the planet, and has a heavy weighting in most baskets. Particularly if you look at Asia, several central banks manage their currencies around a basket of major currencies, with the euro being number 2 after the US dollar. So when there's a significant move in the euro, that has a corresponding impact on what happens to various Asian currencies. And you can see there's across-the-board strength today in Asia, even though it's really got nothing to do with those countries specifically. But the fact that they see the euro moving positively, it moves the Singapore dollar, the Chinese currency, Korean won, Thai baht, all of those are being sucked up in the tailwind of the euro. If you look back over what's happened so far this year, particularly since January, the common theme is that there have been some dislocations, but the US dollar has generally been coming down. Not just it started with the G10 currencies, it's now spreading to Asia, to emerging currencies. It is a pretty sticky move, and it probably has quite a bit further to go. And it's the easy one for macro traders to play. If they feel that caution in America, uncertainty over policies, all of those things are harming the US brand, and the quickest and easiest way for traders to express that is to short the US dollar. And it looks as though they're going to continue to do so.
Talk to us a little bit about that story of the kind of the end of American exceptionalism. This has been a trade that's been baked into the market for about 60 days now, Mark. And I'm curious why you're still seeing so much optimism going into the euro when so many of the countries, France, Germany, Italy, Spain, are dealing with the exact same issues that the U.S. is, which is ultimately coming down to the deficit story, Germany being the exception there, but they're dealing with growth as well. Two issues that the U.S. has still been able to kind of manage. So why the perhaps European exceptionalism story in the face of the non-American exceptionalism story?
Ironically, Germany in particular is one of the countries which is going to be expanding and allowing its deficit to get a bit bigger. They're going to be spending a lot on defence and other factors as well to boost their economy. And ironically, that means even bigger issuance of German government bonds, Bunds as they're known in the market, and that will spill over to other European countries. When people are looking for a place to park a lot of investment, a lot of currency, they also need a very large bond market as well. And surprisingly, that will actually fuel more money going towards the Eurozone. The fact that you're going to have sustained high yields, plenty of depth to the government bond market. That's always been a concern, is whether there's true liquidity or not. We saw at times when we actually had that experience when German yields went negative and liquidity was very poor. Liquidity is improving dramatically and there's more issuance to come. So international investors don't need to fear the fact that when they put money into the fixed income market in Europe, it's just going to disappear. There is depth to the market. The euro can sustain that. So even though it looks like a negative on the face of it, the bigger deficits, more bonds, that's actually, on the flip side, is actually good for the currency. Then there's a question of whether or not investors believe that Europe will ever get its act back together again. Certainly in terms of fiscal discipline, most international investors will think that Europe would have a better plan of eventually reining in its deficits than the United States. For now, there seems to be no end in sight as to when the United States deficit will ever come under even something back to a normal situation. It's been, since COVID, it's just been going higher and higher. There doesn't appear to be a plan to rein it in. So that is a negative, which has been reflected in the Moody's downgrade. And obviously, other rating agencies will watch that fiscal development in the United States, particularly once this tax and spending plan goes through in the US. In the short term, it is not going to help the outlook for the United States in that point of view. And again, that is something that's going to move US dollars away from there looking for other homes, and Europe will be one of those.
Lots of cross currents there. Mark Cranfield, our Bloomberg MLive strategist, joining us out of Singapore to walk us through them. We thank you so much for your time. Plenty else to keep an eye on as we start to see this tariff story unfold. One of them key coming from today at about 2 p.m. Christine Lagarde is going to be speaking. The president, of course, of the ECB. Does the ECB have a reaction function to the latest developments in the trade story with the United States? That's going to be a key piece of commentary that we keep our eye out for. Of course, Wednesday, though, might be the big catalyst for the equity market. That, of course, is going to be the NVIDIA earnings story. Can the A++ student continue to deliver? That's going to be crucial. And then, of course, on Wednesday as well, we have an OPEC Plus meeting. Remember, already talking about plenty of Middle Eastern players there trying to hike up their output. Does that show up in the prices, or is that something that kind of cushions that Brent crude level at a 65 handle? All of that coverage up ahead this week. But coming up on the program, Southeast Asian leaders joined by the Chinese premier and officials from Gulf nations for the Asean summit. We'll take a look at what that means live from the meeting in Kuala Lumpur. That conversation next. This is Bloomberg.
Earnings season is here.
European earnings season in full swing.
They're coming left, right, and center.
It is the earnings season that is dictating the narrative.
Bloomberg is first to break the numbers.
The banking sector, that's the auto sector, HSBC, BBVA, BNP Paribas,
Continental, Ferrari.
All of them really delivering.
With the smartest insights.
I think the rebound that we have seen has been surprising.
The results hit another record high.
Continuing coverage on Bloomberg. Context changes everything.
Welcome back to Bloomberg Daybreak Europe. I'm Kriti Gupta in London. Chinese Premier Li Shang has arrived in Kuala Lumpur for the ASEAN GCC China summit. Now it comes as Southeast Asian leaders seek to deepen ties with China and Gulf nations and mitigate the fallout from President Trump's tariffs. Malaysia's Prime Minister Anwar Ibrahim told the meeting he's pushing for group talks with Washington.
I've taken the liberty also to write to President Donald J. Trump to seek his understanding to organize a U.S.-ASEAN meeting, which means we observe seriously the spirit of centrality.
Bloomberg's Avril Hong is at the ASEAN summit. She, of course, joins us now from location. Avril, just walk us through the significance of Anwar's move here and the Chinese premier being there.
Yeah, Kriti, I mean, here at the ASEAN summit, as you say, and the focus is on tariffs, it's on trade, it is on geopolitical tensions. The Malaysian Prime Minister Anwar Ibrahim speaking there to a room full of ASEAN leaders and saying that he's reached out to the U.S. president asking for a U.S.-ASEAN summit. Now, why is this significant? Because it's not just the ASEAN leaders that are meeting in Kuala Lumpur this week. It is also going to be a trilateral summit tomorrow between the leaders of ASEAN, GCC and China. This is a trilat that's taking place for the first time as these fast-growing economies look to diversify in the face of U.S. protectionism as well as geopolitical tensions. But the nuance here is that these ASEAN countries have to be very careful in not sending the wrong message to the U.S. that they are, amid all this, realigning away from Washington because they are now individually negotiating with Washington for lower tariffs after the White House rejected a suggestion that they negotiate as a bloc. So that is the context, the nuance, the significance of what we're hearing from the Malaysian Prime Minister. In terms of what we're hearing from the Chinese Premier Li Qiang, who is, of course, in Kuala Lumpur from today till Wednesday. This is following on from his visit to Indonesia, where he met with the Indonesian leader Prabowo Subianto. But also keep in mind that this is coming not long following the Chinese president's charm offensive to this part of the world. Certainly, these Chinese leaders are looking to shore up alliances and investment ties at the time with these tensions with Washington. We've been seeing that building of momentum when it comes to key infrastructure projects from China into this part of the world. So that is the context in which we're seeing these visits.
Another key leader in that part of the world this morning, Emmanuel Macron in Vietnam as well. Avril, just walk us through that relationship, what we can expect to hear throughout the course of the day.
Yeah, Emmanuel Macron in Vietnam, but following on from Vietnam, he heads to Indonesia, and then he sort of rounds off the week in Singapore, where the Shangri-La Dialogue, the annual defense summit, will be taking place, and we're expecting to hear from the French leader there. Now, this is coming, of course, as you know, against the backdrop of these Trump tariff threats. Threatened on 50% for the EU, even though we're seeing this delay. So certainly it's this idea that the French leader and perhaps some other EU leaders are drawing to the Southeast Asian nations, looking to shore up investment ties along with alliances. We've already heard how the focus for Macron's trip in Vietnam is going to be about energy, transport, infrastructure. I think state media has also been suggesting there could be a deal signed when it comes to energy power grid. So certainly, as I say, it's about shoring up alliances and investment ties in this part of the world at a time of rising uncertainties with Washington.
All right, Bloomberg's Avril Hong joining us out of Kuala Lumpur. We thank you so much, walking us through some of those key dynamics there. Coming up on the program, Neil Kashkari, president of the Minneapolis Federal Reserve, will be talking about that impact from Donald Trump's tariffs. His comments next on the program. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. I'm Kriti Gupta in London. President of the Minneapolis Fed, Neil Kashkari, says major shifts in U.S. trade and immigration policy are creating uncertainty for Fed officials to move on interest rates before September. He just spoke to Bloomberg's Haslinda Amin.
The fundamentals of the economy coming into this year were absolutely strong. We had inflation that was trending down, not quite back to our 2%, running at about a 2.5% level, and GDP growth that continued to exceed our own expectations for the last few years. So those fundamentals were very, very strong. And now there's been policy uncertainty that has been introduced to it. And that's what's causing this environment that we're trying to navigate. A stagflationary shock, if Jamie Dimon is correct, pushes up inflation, pushes down economic activity. But our monetary policy instruments either push up economic activity and inflation or push them both down at the same time. And that's a particularly challenging environment for policymakers to navigate. And that's why so many of my colleagues and I are saying we're really in a wait-and-see mode until we see which of these two effects, activity or inflation, which is the bigger effect that ultimately should drive our policy path.
As it stands now, Neil, how would you rate the chances of a stagflation? 30%, 40%?
Well, I think there's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now, they're at a very high level, highest in 100 years. And how long a period both is this uncertain environment and how long are the tariffs going to last? If we have high tariffs for a month or two, but then they're negotiated much lower, the stagflationary imprint of that is going to be much, much lower. If we ultimately settle at a high rate for the foreseeable future, then the stagflationary impact will be much larger. And so is it stagflationary? Yes. But the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Minneapolis Fed President Neil Kashkari there speaking with Bloomberg's Haslinda Amin. In the meantime, let's get a quick check on those markets here, because remember, the UK and the U.S. is closed. Today is Memorial Day in the United States. It's a bank holiday here in the UK, but European markets are very much open, and so are the futures markets as well. And you can see optimism across the board, some outperformance in the NASDAQ 100 futures as well. That simply might be a reversal from what we saw on Friday. When you look at the European future story, that's where you see the real action here, and that's, I think, is going to be crucial, because when you look at the European futures, higher by 1.7% this morning, and Eurodollar is getting in on that action. We're looking at a 114 handle on Eurodollar and a 135 on the pound. Lots of positivity baked into these markets. Does it last into the European Open? Stick with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Kriti Gupta in London. These are the stories that set your agenda. President Trump extends the deadline for the European Union to face 50% tariffs until July 9th. It comes after a phone call with EU Commission President Ursula von der Leyen. And European equity futures rally off the delay with UK and U.S. cash markets closed for the public holidays. And Donald Trump saying he's considering sanctions on Russia, calling Putin, quote, absolutely crazy, a day after Moscow launched another deadly night of strikes across Ukraine. Lots to digest in the geopolitical space. Let's get a quick check on these markets as well, because you are seeing green on the screen when it comes to the futures picture. Again, cash equity markets are closed in the UK and the United States, but the European markets very much open, higher by 1.6% when it comes to the Euro Stoxx 50 futures and S&P futures tailing that as well to the tune of about 1%. Euro dollar trading at 114. That continued optimism, at least when it comes to euro, or is it pessimism in the dollar that's really driving those flows? We're going to dive into those details shortly. And of course, Brent crude trading at a 65 handle as well. Let's get a quick check, or return, I should say, to our top story, which is, of course, those 50% tariffs inflicted by Donald Trump. Now, something that he says he will pause when it comes to the European Union. That is until July 9th. It comes after speaking with Commission President Ursula von der Leyen in a move that allows for more time to negotiate a trade deal between Washington and Brussels. Now, of course, a close watcher of that relationship, Bloomberg's Oliver Crook, joins me this morning. Ollie, walk us through what we know here and how this U-turn came about.
Yeah, Kriti, well, how the U-turn came about is basically, it seems, a phone call between Ursula von der Leyen and Donald Trump over the weekend that Donald Trump said was very good, and that he was going to grant basically the EU this a little additional time that they desire to July the 9th, which takes it basically to that full original 90-day extension of the tariff negotiations between the EU and the United States. But again, Kriti, this is just kind of a deja vu once again, right? If you had actually turned your phone off at about lunchtime on Friday here in Europe and then turned it back on today, you basically wouldn't have made too much of a difference, right? That threat of 50% tariffs coming in on June the 1st, that was next Sunday. That gets a very truncated timeline, only for that to evaporate, to be pushed back into the end of July. Bearing in mind that there are still 10% tariffs between the EU and the United States, 25% tariffs on steel, aluminum, and the automotive sector. And of course, this threat now of 50% between the EU and the United States is even higher than the current trading tariffs that exist between China and the United States. So again, this is going to be the sort of regrettable tone in which this is all going on forward for the European officials, but it grants them a little bit more time to finalize their proposals that basically, the United States wants to see more aggressively proposed by the EU because they failed to deliver them anything that they really desire at this point.
Do we see some sort of negotiating path forward, though? I know a phone call sounds positive, but this is coming after, I want to say, less than 2 weeks where Scott Bessent talked about Europe having a collective action problem, Donald Trump calling the EU a nasty bloc to deal with. Is this really kind of the path forward? Is it that clear?
Yeah, I mean, collective action problem is arguably the EU's middle name, right? They do manage to come together in moments of crisis, but of course, it's not a country. So they have to negotiate things at the member state level a lot of the time. They need to build those consensus between 27 different countries and then go out and present those to the world, which is why it makes it very difficult for such an organization to negotiate with the Trump administration, which works very sort of whimsically and is governing right now, in large part by executive order, is able to move much more rapidly than the EU ever could. So the EU sort of has put forward a proposal that includes a number of things, including sort of enhancing economic security, mutual investments. We understand there was also an EU-U.S. energy partnership on gas, nuclear, and oil that was being proposed. There's also discussions around agricultural standards, right? This is one of the great beefs that the U.S. administration has with the Europeans, that their agricultural standards, their food standards are too high. So as a consequence, they don't accept a number of things, including beef, the beautiful beef cited by Howard Lutnick. These are the things that cannot get into the European Union. These are sort of the issues that they would like to diminish, right? So the EU has put forward some of those proposals, but I think probably at this stage, the EU will have to put something much more sort of clean, much more clear, something like a long-term agreement to buy LNG or weapons from the United States, because the trade deficit right now is at about 200 billion euros. You could probably fairly easily make that up by just really buying a huge amount of LNG and weapons from the United States, both of which, by the way, the Europeans need to do and have made some of the fiscal space to do. So potentially that is a way to close the gap in a way that the Trump administration will be pleased with.
So, Ollie, you're sitting in Berlin, and you have been a key watcher of not only this dynamic, but what's going on with auto tariffs and the auto sector broadly kind of being the backbone of Germany and in some areas the backbone of Europe as well. That is just one sectoral tariff that has come from Washington. And since Donald Trump took the presidency, there are others coming down the pike, including pharmaceutical tariffs. I'm looking at a fun fact right now, if you'll indulge me, which is saying that pharmaceuticals are the single largest EU-produced product shipped to the United States. How do sectoral tariffs balance with an EU total tariff?
Yeah, so the pharmaceutical sector, as you mentioned, is actually just number one. It's just ahead of the auto sector. And as far as Germany is concerned, of course, the autos are probably the bigger deal. But, you know, for example, the biggest exporter to the United States by sort of these sort of categories isn't Germany, it's Ireland. And it's precisely what you're talking about through the pharmaceutical sector. We've heard very little now. You know, this was the sort of big mantra for the Trump administration for, you know, a 48-hour so news cycle was the pharmaceutical sector. That has sort of evaporated. But this is one of the big issues that is facing the Europeans still. I think, though, as far as the Europeans are concerned, even if they do manage to reach a deal with the United States, I think that their great fear is a couple of things. One of them is that there's so much cross-contamination between different sort of policy issues, right? The Trump administration, in the same breath as is sort of complaining about trade with the European Union, is also talking about litigation against American tech companies and seeing those two things as connected. So I think for the Europeans, even if they do get a deal on this, what is preventing the Trump administration then to go put some tariffs on pharmaceutical? Or if something else happens, you know, using that trade lever to basically get whatever they want from the Europeans. And that, I think, is the calculation that many countries are making with this new Trump administration. And for the Europeans, again, they would like a deal in the short term. They absolutely need a deal. They have a $200 billion trade deficit with the United States. They have $1 trillion worth of trade going both ways. It's absolutely monumental. But what they need to be concerned about, and what they are concerned about, is insulating themselves in the future from a very unpredictable Trump administration.
Certainly something I think everyone in the world is trying to do at the moment. Bloomberg's Oliver Cook joining us in Berlin to walk us through those cross currents affecting the European economy. We thank you so much. We'll talk about how the U.S. is viewing those developments. U.S. Treasury Secretary Scott Bessent expecting several large trade deals to be announced in the coming weeks, and for more in-person talks with China. Now, Bessent spoke with Bloomberg about that impact of revenue from tariffs and also hit why talks with the EU are proving more difficult. Take a listen.
We have substantial revenue coming in now, and there is, at some point, there's an equilibrium rate, let's call it a Laffer curve, for tariffs. And I think we will reach that rate. The other thing that's happening is a lot of their tariff barriers or non-tariff trade barriers. A lot of these non-tariff trade barriers are coming down, so friction's decreasing there. And again, because we don't know where these tariff negotiations are going to end up, they won't end up being scored. But it's several $100 million a year, several $100 billion a year of revenue that will be used. For every $100 billion, that's $100 billion less of bonds that Treasury has to issue.
When you talk about uncertainty and getting more certainty because of the tax bill, some of the uncertainty, a lot of it is because of tariffs right now, because we're not exactly sure where we're going to end up. Do you have a sense when the economic community, the business community, will get better certainty on tariffs?
Well, we've done the 90-day pause. As I've mentioned several times, we have 18 important trading partners. So what everyone should really focus on are those. We've done a deal with the UK. My sense is over the next couple of weeks, we're going to have several large deals announced. We have put a pause and a 90-day pause with China. I expect that we will be negotiating in person with them again. And then the president today, when we initiated the pause and the 10% are moving down from the April 2nd rate to the 10% level was contingent on countries or trading blocs coming and negotiating in good faith. And I think the president was getting frustrated with the EU. The problem with the EU, I've said several times, they have a collective action problem. There are 27 countries. They all have different needs. The Germans, they are interested in cars, the French in agriculture. And then you have Brussels negotiating with them.
U.S. Treasury Secretary Scott Bessent speaking with our very own colleague David Weston over in the States. Let's talk about some of the other news that is coming from the United States. President Trump saying he is considering new sanctions against Russia after Moscow launched a second night of deadly missile and drone strikes across much of Ukraine. Now, Trump's comments come as he appears to grow frustrated with Russian President Vladimir Putin, with ceasefire efforts losing momentum.
Absolutely. He's killing a lot of people. I don't know what's wrong with him. What the hell happened to him, right? He's killing a lot of people. I'm not happy about that.
I'm joined now by Bloomberg senior editor Bill Ferries to walk us through the latest. Bill, pleasure to have you on the program this morning. Talk to us a little bit about Donald Trump's comments there. Is this a concrete shift in how he's approaching Russia and Ukraine?
Thanks for having me. Yeah, it's certainly stronger comments than we've typically seen from the president, who's more frequently criticizing Ukraine and Ukrainian President Volodymyr Zelensky. That said, we have heard the president threaten sanctions on Russia before. We have not seen the U.S. really take concrete steps in that direction. So until that happens, I think it's going to be more of a rhetorical threat and less of an actual threat. I mean, overall, we've seen the U.S. really kind of step away from peace negotiations. There was a phone call with Vladimir Putin just over a week ago, but we haven't seen actual steps towards some kind of a ceasefire, towards some kind of a high-level peace negotiations taking place. So every time that there is one of these larger bombardments from Russia, we see the president speak out. But really, the action hasn't followed, and I don't know that we're seeing, it's just not clear whether that's going to happen again this week. We'll be watching for that.
Well, talk to us about his approach when it comes to the actual sanctions picture, because this is something that Europe has been feeling very strongly about. They're actually kind of doubling down on that sanction story. If the U.S. adds an even larger layer, walk us through the impact it could have at this point.
Well, there's a lot of things happening right now. I mean, we do see the EU weighing sanctions on almost 24 banks, looking at evicting them from the SWIFT payment system. We're looking at them making moves to really wean themselves off of Russian fossil fuels by 2027. So that is all taking place as the U.S. kind of stands to the side. We have seen some moves to target specific oil tankers to go after this dark fleet that has really been helping keep revenue flowing into Russia. And one thing that's kind of external to all this is that the oil price has really kind of dropped a bit from the near $80 a barrel we saw at the start of the year. We're talking more about $62 to $65. That is a real revenue hit for Russia's economy. They have to sell their oil at a discount to get it out on the market. If the U.S. and the EU together can really target that oil revenue and look at some of the banking sector, that is going to be a lot of extra economic punishment for Russia. We need to see, I think Russia will respond to both the economic punishment and incentives on the battlefield. We've seen them making incremental progress on the battlefield so far. If the U.S. gets more involved in pushing back, supplying more weaponry, things like that, analysts do think they do see some leverage to do some damage to Russia here. But so far, the U.S. is really, by and large, standing aside and letting the EU kind of take the lead. And as you mentioned in your previous segment, there is a collective action issue. It does take a while for the EU, when considering sanctions, to implement those.
Certainly something that we're going to be keeping a very close eye on. Collective action problem until there's a crisis, it seems. Is this a crisis to warrant that? Bloomberg's Bill Ferries walking us through the thinking over at the States. We thank you so much. Let's go to some of the other stories making news around the world. Israel's military aiming to take over 75% of the Gaza Strip within 2 months. That's according to local media accounts of a military briefing. The offensive aims to defeat Hamas or force the exile of its leadership and press the group to release the last of its hostages taken nearly 2 years ago. Now, under the plan, the entire population of some 2 million people would be forced into 3 areas, making up just a quarter of the territory. And U.S. President Donald Trump says he had, quote, very good talks with Iranian officials over the weekend on his push to put on limits Iran's nuclear programs. Officials from the Islamic Republic say the discussions could lead to an agreement in the next couple of meetings. Tehran saying it doesn't seek a nuclear bomb, but wants material to power nuclear power plants. And shares in Nippon Steel have given back some of their earlier gains, having climbed more than 7% in Tokyo. It comes after President Trump announced what he called a, quote, planned partnership between U.S. Steel and the Japanese company. Trump said the deal would create at least 70,000 jobs and add $14 billion to the U.S. economy.
It'll be controlled by the United States. Otherwise, I wouldn't make the deal. I went to the unions, to all of the local unions. They all wanted it. And I'm doing it because all of the congressmen came in, about 5 of them, and the others, I understand, are in concurrence, and they asked that I do it. Everybody seems to want it.
The Financial Times reports that SoftBank founder Masayoshi Son has proposed setting up a U.S.-Japan sovereign wealth fund aimed at making large investments in technology and infrastructure. Sources telling the FT that Son has discussed the plan with U.S. Treasury Secretary Scott Bessent. The fund would be jointly owned and run by the U.S. Treasury and Japan's Finance Ministry, each holding a significant stake. Now, coming up on the program, futures on both sides of the Atlantic gaining after Donald Trump extending the deadline for the European Union to face 50% tariffs. We're going to break down the market action next. Stick with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. I'm Kriti Gupta in London. Now, there's plenty going on in these markets. It is a bank holiday in the UK. It's Memorial Day over in the States. But European markets continental European markets, I should say, are very much trading. Futures indicated a massive open, and a lot of that coming from the tariff delay coming out of the United States. A phone call with EU Commissioner Ursula von der Leyen and Donald Trump completely turning around sentiment that was pretty sour on Friday. But the question is, how long does it last? I don't have the answer, but I'm going to bring in someone who does. Bloomberg MLive strategist Mark Cranfield joins the program this morning with some more analysis. Mark, we had you earlier on in the show talking to us about the strength in the euro, really this dollar weakness story that has been fairly persistent. Talk to us about the other assets in Europe and arguably Asia as well. If we're seeing an exit from U.S. assets, how long does that last when, say, a potential 50% tariffs could be coming down the pike for Europe?
Yeah, I mean, it's going to go on for some time. It's the common thread between what you saw on Friday and what you're seeing today is that the euro currency, it gained on Friday when the tariffs, in theory, were going to be 50%. Now they've been delayed and the euro is still gaining again. So clearly, the flip side of a strong euro is obviously people selling the US dollar, people moving their assets to other places. And we've had a reinforcement of that in Asia today because of the Chinese fixing. So every day we have this fixing between the dollar and the yuan set by the central bank in China. And today they gave a clear indication to markets that they were willing to allow the yuan to get a little bit stronger. So they set the fixing today at the lowest level since the time when we had the so-called Liberation Day by President Trump. So we had a complete reversal here in the currency exchange rate between the dollar and the Chinese currency, where at first the Chinese currency weakened. It's now gone through full cycle. It's starting to strengthen again. And the Chinese central bank is becoming more comfortable with the idea that it can allow its currency to get in line with what it's seeing in the G10 class. That's the euro, the yen, the Swiss franc, the pound as well, which is having a good run, and what it's seeing in the Asian currencies. That was initially led by the Taiwanese dollar. If you remember, we had a surge at the beginning of the month in the Taiwanese currency as it beat up everybody in Asia. That's settling down, but that currency is still very strong. The Singapore dollar, Malaysian ringgit, Thai baht, they're all performing pretty well. And now China is allowing its currency to get in line with what it's seeing in Asia as well. So really, it's what you might call a full court press. We're seeing dollar weakness against major currencies, against emerging currencies. It's now broadening out around the world. And it's the theme which seems to be intact, regardless of the fluctuations you see in equity markets, whatever happens in bond markets, that narrative of people moving money away from the US dollar, macro traders especially. They like this because it's a clear-cut trade. Their view on the US, their way of expressing a view on America is that it's confusing. They're losing confidence in the way policies are dealt with there, so they're shorting the currency. That's the cleanest way they can express it, and it looks as though it's going to go on for some time.
Mark, very quickly, talk to us about this bond market as well. If we're concerned about things like stagflation, what does that do to a 10-year yield?
We had that this morning. Neil Kashkari was on Bloomberg television speaking out of Japan, ironically, and he was saying that stagflation, whichever way you cut it, is going to be a negative because people want a bigger term premium. That means to say that they need more compensation for long-term yields relative to short-term yields. The fact that he was saying it in Japan is because they have exactly the same problem. First quarter this year, Japan was in contraction, but inflation is running well above 3%. At the end of this week, we're going to have Tokyo CPI. It's probably going to be 3.5%. It's going to reinforce the stagflation pressures in Japan as they are in the United States.
Certainly something we're keeping a very, very close eye on. Does that trade continue? Bloomberg MLive strategist Mark Cranfield joining the program this morning. Plenty more analysis ahead. Stick with us. This is Bloomberg. Welcome back to Daybreak Europe. Now, it is a closed market session for the UK and for the United States, but the European market's very much open, which is why we are here at work today. There are three charts that I really want to bring to everyone's attention because I think the story of the last 48 hours that is likely to get priced in, one today and then two tomorrow as the UK and the US markets come back online, is going to be this global growth story emanating from these trade disputes. But this is a chart that I think is really important because we're talking about the slowing growth forecast around the world. And you can see that the trajectory since the start of the year has been largely negative. And that is going to be a crucial piece of the equation because how much room does that leave central banking? That is what Jay Powell and his peers around the world have to contend with, including another factor, which is the deficit story. And that's where the long end of the bond market has really been trading. This chart is going to be crucial to that conversation because even though you have these varying degrees of growth for the three different regions, global yields are doing the exact same thing around the world, which is they are going higher. The long end is selling off. Nobody wants to be holding that risk. They don't feel like they're being rewarded with the proper premium as well. Lastly, I'll leave you with this trade deficit story. It is our top story this morning of just how big that gap is. We're going to dive into the details in the opening trade next. Stick with us. This is Bloomberg.